Hey guys, it is Julie here with TipRanks. Today we're taking a look at 3 growth stocks in the food delivery and ride-sharing industry. So let's get into it. Alright guys, welcome back and thank you all so much for being here. Like I said, today we're looking at 3 stocks that deal in the food delivery and or ride-sharing industry. So we're going to compare these stocks and their different offerings and see how analysts are weighing in on their stock's future. Just before we get into all of that, this is your friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well so you can stay up to date with all of our latest videos. Alright, let's get right into these 3 growth stocks. Actually, one other quick piece of information before we jump into these. You will notice a decline in price on all of these stocks today in the last couple of weeks. This, of course, was a bit of a downturn in the market as there were certain concerns over a variant that was spreading. So this could be a great buying opportunity, just to keep an eye on those prices. First on our list today is food delivery service DoorDash. Their stock trades under the ticker DASH or DASH and is currently priced at $162.89 per share. DoorDash is a tech company that connects consumers with their favorite local and national businesses in more than 7,000 cities. DoorDash gained a ton of popularity over the past couple years during the pandemic, as many people were stuck at home and so ordering in food became extremely popular. DoorDash initially launched with a focus on restaurant food deliveries, but have been expanding and diversifying ever since, including services like deliveries from pet stores and grocery stores. Just yesterday, they announced a new ultra-fast grocery store delivery service. This will include deliveries within 10 to 15 minutes, beginning with DashMart in New York City, which offers over 2,000 different items from fresh and frozen grocery staples, snacks, household goods, and local products. A big announcement for DoorDash came back in November when they announced they would be acquiring Wolt. Wolt is a Helsinki-based company that was founded back in 2014 and now employs over 4,000 people. They make it incredibly easy to discover and get the best of local restaurants, grocery stores, and other local shops delivered to your home or office. Operating in over 23 different countries, they have over 2.5 million monthly active users and an annual run rate GOV of $2.5 billion and saw 130% year-over-year growth in their last quarter. With this acquisition, DoorDash and Wolt would now operate in markets that cover over 700 million people. DoorDash just shared their most recent quarterly earnings report on November 9th. They saw revenues grow 45% year-over-year to $1.3 billion, and total orders grew 47% year-over-year. Their GAAP gross profit of $665 million increased 42% year-over-year. Weighing in on the DoorDash stock following this earnings report was 5-star analyst Brad Erickson from RBC Capital. Erickson said that we believe open-ended total addressable market expansion trumps inevitable core deceleration into next year. The Wolt acquisition expands the company's reach into 23 new countries, primarily in the Nordics, Northern Europe, Israel, and Japan, an estimated 138% increase relative to the company's prior U.S. total addressable market for food delivery and a 122% increase for retail. Erickson is one of 19 analysts that currently have a rating on the DoorDash stock, and it comes in as a moderate buy based on 10 buy ratings and 9 holds. The average price target comes in at $238. That would be an upside potential of over 46% for the next year. Now on the low end, we do have our hold ratings, which still have a fairly attractive upside of 23%. On the high end, we have several ratings at the $270 price point, which would be a 66% upside potential. Second on our list today, we're moving over to ride sharing with LYFT. Under the ticker LYFT, their stock is currently priced at about $43 per share. LYFT operates as an online social rideshare community platform, helping commuters to share rides with friends, classmates, and coworkers going the same way. They recently launched a membership option called LYFT Pink. The membership is available at $19.99 per month or $199 per year, and includes different perks like 15% off of ride shares, a free Grubhub Plus membership, 3 free classic bike rides per month, and free scooter rides, and relaxed ride cancellations. LYFT also offers different services like their LYFT Business Portal. These business profiles make it easy for employees to expense or charge rides directly to a centralized account. And their LYFT Pass allows you to cover the cost of rides for your employees, customers, guests, patients, and more with built-in controls for budget and usage. LYFT shared their third quarter results on November 1st. They saw Q3 revenue of $864 million, which was a 73% year-over-year growth and outpaced their midpoint outlook by $10 million. They also had a record revenue per active user of $45.63. Their adjusted EBITDA came in at $67 million and nearly tripled quarter over quarter and also exceeded their outlook. Weighing in on the stock is five-star analyst Stephen Ju from Credit Suisse. Now, he had a lot of points to make, so I had to shorten it down to just a few. He touches on them scaling up their white label delivery solution, which remains a B2B offering. With this, Lyft is effectively helping to transform for its partners what is at times a fixed cost base into a variable. There's significant opportunity remaining for share capture of the $9,000 annual transportation spend among U.S. households, as standard rideshare companies comprise just 5% of that. And the Lyft Pink adoption is set to rise as there are new product enhancements slated for next year and recent innovations, including unlimited 45-minute classic bike rides. He is one of 20 analysts that currently have a rating on the Lyft stock, and this one comes in as a strong buy based on 15 buy ratings and 5 holds. The average price target comes in at $70.76. That would be an upside potential of 63.5%. On the low end, we do have a hold rating, which still has a 34% upside. On the high end, we have a price target of $95, which would be growth of nearly 120%. And last but not least, we're looking at a company that has the best of both worlds, offering both ride-sharing and food delivery. That is Uber Technologies. Trading under the ticker Uber, or UBER, they're currently priced just shy of $40 per share. Now, like I said, Uber pretty much offers it all, starting off with their ride-sharing and ride rentals. This includes their Uber Green, which offers rides in electric vehicles, Uber Rent, where you can actually rent a car for a longer period of time, to everything like bikes, scooters, and even rickshaws. And of course, on the food delivery side, we have Uber Eats, which also gained a ton of momentum during the pandemic for at-home food deliveries. They recently brought Drizzly into the Uber Eats platform as well, allowing favorite beers, wine, and spirits to be delivered too. On top of this, they also have Uber Freight, which is a free app matching carriers with shippers, and Uber for Business for employee travel or customer rides. Similar to Lyft, Uber has also launched a membership option called Uber One. This membership is offered at $9.99 per month, or an annual price of $99, and includes member pricing guaranteed with 5% off all eligible rides, unlimited $0 delivery fees on orders over $15, and priority service with top-rated drivers on rides and elevated member support. Uber's Q3 earnings report came out on November 3rd. They shared that their Uber gross bookings reached an all-time high in October, up 45% versus 2019. They saw revenue of over $4.8 billion, which was a 72% year-over-year growth. And their adjusted EBITDA came in at $8 million, which was a $633 million year-over-year improvement. Weighing in on the Uber stock is Brian Nowak from Morgan Stanley. He stated that Uber's new offering provides a greater selection of benefits at lower cost than competitor offerings, while better emphasizing Uber's multi-product advantage more than its previously segmented offering. We think a more cohesive subscription offering will be important as Uber looks to drive incremental gross bookings post-recovery and compete more effectively against Lyft and Dash. And Uber does seem to have an edge over Lyft and Dash, as we have 20 analysts weighing in with a strong buy rating based on 19 buy ratings and just 1 hold. Their average price target comes in at $69.75 for our highest upside potential of over 75%. And it's actually hard to find a low-end price target here. It is our hold rating, which there was too many ratings to fit on the screen, but did come in with a 26% upside. Then on the high end, we have a couple ratings, the most recent being an $80 price target, which would be growth potential of nearly 102%. So there we have 3 stocks in the food delivery and or ride sharing industry. Now, you guys know I always love hearing from you guys, so let me know your thoughts on these 3 companies and what you think of those analyst price predictions. Of course, these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. Please make sure you're always doing your own research and due diligence before making any investment decision. If you made it to the end of today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Thank you guys so much for watching. I hope you have a fantastic day, and I'll see you back here next time.